Ever wondered how hedge funds use math and data to make decisions? If you're a high school student interested in finance but not sure where to start, this is for you. This free course is sponsored by the Eureka program, where we connect students with experts to explore advanced topics in research and industry. The content in this course was created by a professional hedge fund manager, so you're learning from someone with real-world experience. We're going to break down quantitative finance, how math, data, and financial markets come together to make smarter decisions. Before we begin, just a quick note. This is not investment advice. This course is for educational purposes only. Your money, your decisions, your risk. If you're thinking about investing, always do your own research and talk to a financial advisor or other professionals before making any financial decisions. If you're ready to learn, hit that subscribe button, give this video a like, and let's get started. First of all, what is the efficient market hypothesis? Imagine you're at a huge farmer's market. There are hundreds of people buying and selling fruits and vegetables. How does everyone know what a fair price is? That's exactly what we're going to talk about today. Except instead of fruits, we'll look at how the stock market processes information to set prices. Stock prices change all the time, and sometimes it feels like they react instantly when news comes out. Why does that happen? This is where the efficient market hypothesis, EMH, comes in. Dr. Eugene Fama, the economist who developed this theory, explains it like this. In an efficient market, competition among many intelligent participants ensures that prices accurately reflect all available information, both about past events and what the market expects to happen in the future. In simple terms, an efficient market is one where stock prices quickly and correctly adjust to new information. This means that at any moment, the price of a stock should be a fair representation of its actual value, based on what's known at the time. The efficient market hypothesis can be broken down into 3 different levels. Think of the efficient market hypothesis like 3 expanding circles, each representing how much information is factored into stock prices. 1 weak form, efficiency. This is the innermost circle, meaning it only considers past prices and trading data. It states that historical prices and trading volume can't predict future prices. Why? Because stock prices change based on new, random information. If this is true, then technical analysis, the practice of looking at price charts to predict trends, wouldn't work. Research supports this because historical prices are easy for everyone to access. If there were patterns, traders would act on them immediately, making them disappear. 2. Semi-strong form efficiency. This is the middle circle, where stock prices reflect all publicly available information, not just past prices. This means that once earnings reports, economic data, or company news are released, prices adjust almost instantly. If this is true, then fundamental analysis, where investors study financial statements and industry trends to find undervalued stocks, wouldn't work because the stock price would already reflect that information. But here's the catch. Public information is hard to collect and process. For example, what if you wanted to predict Target's sales by counting cars in every Target parking lot across the country? That information is technically public, but it's difficult to gather and analyze. Because of this, markets aren't perfectly semi-strong efficient, but they're pretty close. 3. Strong form efficiency. This is the outermost circle, which says stock prices reflect all information, even private company secrets. If this were true, even insider trading using secret company information to trade stocks wouldn't give an investor an advantage. But we know this isn't true because insider trading laws exist for a reason. If a CEO secretly decides to buy another company at a 50% premium, the stock doesn't instantly jump 50% because that information isn't public yet. Research shows that markets are not strong form efficient because private information can give some traders an unfair advantage. Why don't markets fully reflect all information? There are 3 key reasons why stock prices aren't all perfectly efficient. 1. The cost of collecting information. Some data is expensive or difficult to obtain, so not everyone has access to it. It's from the difficulty of processing information. Even if you gather all public data, analyzing it fast enough to act before the market moves is extremely difficult. 3 laws that prevent trading on certain information. Insider trading laws prevent people from using private, non-public information to make money in the market. This is why. The weak form is generally true, since past prices are easy to access. The semi-strong form is somewhat true. Public info is available, but hard to process. The strong form is false. Insider trading laws prevent full information flow. Final thoughts. What does this mean for investors? Understanding market efficiency helps us think critically about investing. Markets are good at processing information, but they're not perfect. The more accessible the information, the more efficient the market. The harder the information is to gather and analyze, the less efficient the market. If a market were perfectly efficient, no one could consistently beat the market. That's a quick introduction to the efficient market hypothesis. In our next video, we'll break down the capital asset pricing model, CAPM, a key tool for understanding risk and return in financial markets. If you found this helpful, hit that subscribe button, like this video, and let us know what you think in the comments.